And I'm Mira.
Before we jump completely into today's paradox, just a really quick reminder for you listening. Today's discussion is strictly for market context and analysis.
Yeah.
It is, it's not personal investment advice or a recommendation to buy or sell anything.
Right, absolutely. We're just here to kind of map out the underlying architecture of what is actually moving the tape today.
And, well, what a tape to map out. Today is Wednesday, April 22, 2026. And the mission of our deep dive today is to really untangle this massive global contradiction.
It is a profound disconnect, honestly.
It really is. I mean, on one side, we are looking at severe kinetic geopolitical escalation. We have a literal U.S. naval blockade in the Middle East that's threatening to send global supply chains and, inflation straight into the stratosphere.
Which normally would terrify investors.
Exactly. But then on the other side, we have this absolutely unstoppable artificial intelligence capital expenditure boom, and it's basically insulating U.S. equities. So our goal today is to explain to you exactly why and how the markets completely shrugged off global chaos today to rally to near record highs.
Yeah, it's like we are watching traditional geopolitical gravity just completely fail to pull down equity valuations.
So Mira, looking at the overnight action and carryover narratives, what set the stage before the U.S. session?
Well, to really understand how we arrived at today's incredible rally, we kind of have to look at the momentum that was already building before the opening bell. For the past few weeks, markets have been staging this very sharp V-shaped recovery.
Driven mostly by those Q1 numbers, right?
Exactly. That baseline optimism was initially fueled by incredibly strong first quarter corporate earnings across the board. I mean, the American corporate engine has been seriously proving its profitability.
But hovering over all of that fundamental optimism has been this lingering, really heavy threat of severe energy shocks.
Yeah, that's the dark cloud.
Right, because just a few days ago, on April 18th, Iran briefly reblockaded the Strait of Hormuz. And for anyone not staring at maritime maps all day, that is a massive global choke point. It handles roughly a fifth of all global seaborne oil.
Which is huge. That's not just a localized regional issue. That is literally the main artery for the global industrial economy.
And when that specific artery gets squeezed, energy prices mechanically spike.
Right, and that price action feeds directly into broader headline inflation. If inflation reignites, it basically forces global central banks to hold interest rates higher for much longer than they anticipated.
And that hurts valuations, because higher rates increase the discount rate that gets applied to future corporate cash flows.
Exactly. In simple terms, when the cost of borrowing money goes up, the present value of future corporate profits goes down, which, normally crushes equity valuations.
So that fear of the discount rate was the main dark cloud hanging over the market. But then we got a massive late-day catalyst on Tuesday.
Right, the ceasefire news.
Yeah, just after U.S. markets closed, around 4:10 p.m. Eastern Time on April 21, President Trump unexpectedly announced an extension to the Iran ceasefire.
And that announcement was really the crucial pivot point for overnight trading. By extending that ceasefire, the immediate, kinetic tail risk of a full-blown regional war was basically taken off the table, at least temporarily.
Which changed the whole math for traders.
Completely. In financial mechanics, this allowed the equity risk premium to compress overnight.
Let's actually pause and define that, because equity risk premium gets thrown around a lot on financial television. If you're an investor, you naturally demand a premium, like an extra return, to justify holding risky assets like stocks instead of safe government bonds, especially when there's a threat of war.
That is the perfect way to look at it. When missiles might fly, that demanded premium skyrockets. You want to be heavily compensated for taking on that geopolitical risk.
Makes total sense.
But when a ceasefire is extended and you remove that immediate threat of a broader conflict, the premium shrinks. And when the risk premium shrinks, stock multiples can instantly re-rate higher.
Because investors are suddenly willing to pay more for the exact same dollar of corporate earnings, right?
Yeah.
The perceived systemic risk has evaporated.
Exactly. Which brings us to the overnight energy data that dropped before the U.S. session began. The Energy Information Administration, the EIA, reported a crude oil build of 1.925 million barrels.
Now, on the surface, a crude build sounds like there is excess supply sitting in storage tanks, which should normally push prices down.
Right. But if you look under the hood of that report, there were massive draws in refined products. I mean, gasoline inventories plummeted by 4.57 million barrels, and distillates were down nearly 3.5 million barrels.
Oh.
Yeah. The refined product data is a much purer, much faster signal of end user demand than just raw crude storage.
So a massive draw in gasoline means everyday consumers are still filling up their tanks and driving to work, completely undeterred by the underlying geopolitical noise.
Exactly. And a massive draw in distillates, which, includes diesel fuel, means the industrial economy, like the trucking, freight, and logistics networks, are still humming along at full capacity.
The underlying economy is basically ignoring the higher prices at the pump. It's paying the premium and just keeping the engine running.
Meanwhile, though, the overnight data out of Europe told a completely different, much darker story.
Oh, yeah. The German Bundesbank officially downgraded its 2027 economic growth forecast to a rather dismal 0.9%.
And they explicitly cited structurally high energy costs as the main culprits squeezing their industrial base.
So stagflationary conditions in Europe are becoming a severe structural drag. They're dealing with stagnant growth and high inflation simultaneously.
But in a really fascinating contrast, just across the channel, the UK reported March core inflation that was actually softer than expected, coming in at 3.1%.
Which gave the markets a little boost.
Yeah, that single data point gave global central banks a glimmer of disinflationary hope. It offered a narrative to bond markets that maybe, just maybe, central banks might still have the runway to cut interest rates later this year.
Here is where I have to push back a little on the market's reaction, though. I mean, is the relief over that UK inflation print totally premature? We just established that global energy prices are structurally tight due to the Middle East, and refined product demand in the U.S. is incredibly robust.
Right.
So doesn't that mean this disinflationary trend in the U.K. is going to hit a brick wall the very moment those new higher energy costs filter through the manufacturing and shipping supply chains?
That tension is absolutely the core vulnerability of the current market narrative. Energy costs act with a distinct lag. The UK inflation data we saw overnight reflects the reality of the past quarter. But the crude oil tightness we are seeing today dictates the manufacturing costs of the future. If oil stays elevated near $100, that 3.1% core inflation reading in the UK is likely the floor, not a stepping stone on the way back down to their 2% target.
It feels like the bond market is basically celebrating the view in the rearview mirror while driving straight into a hurricane.
Honestly, yes.
So that tension, a momentary ceasefire relief masking structurally broken energy markets, that was the powder keg sitting on the desk when the opening bell rang in New York. Let's signal a quick break here, and then we'll dive into how the U.S. session actually played out.
Sounds good.
Welcome back. So what actually moved markets during U.S. trading hours today?
Pure defiance, honestly. We saw a massive risk-on rally. The S&P 500 closed up 1.05% at 7,137.90, and the tech-heavy Nasdaq surged an impressive 1.6% to 24,657.57.
And the Treasury markets were bizarrely quiet given everything going on. The 10-year yield basically flatlined around 4.294%.
Right, and corporate credit markets, specifically high-yield and investment-grade ETFs, easily absorb the risk appetite without widening their spreads.
Which is a massive signal. If the underlying economy was truly panicking about a global war or an energy crisis, you would see credit spreads widen as lenders demand higher interest rates to lend to risky corporations.
Exactly. The fact that high-yield bonds absorbed the day's events so calmly shows that institutional money believes corporate balance sheets are strong enough to weather the storm.
I want to look closely at the geopolitical tug-of-war that was unfolding while the market was rallying, though, because the messaging around this ceasefire extension was absolute whiplash.
It really was.
On one hand, you have President Trump purportedly demanding a comprehensive final agreement from Tehran by Sunday, a hard deadline. But then White House Press Secretary Leavitt comes out and publicly insists that timelines are flexible, that the president hasn't set a firm deadline, and that the U.S. will dictate the timetable on its own terms.
That kind of contradictory communication creates a tremendous amount of volatility in the high-frequency trading algorithms that, scan and trade off news headlines.
Well, this is noise to them.
Yeah. The market is constantly trying to price in a binary outcome, like will there be a war or will there be peace? But the inputs it's receiving from the administration are deeply conflicting.
Let me apply a game theoretic lens here, because I don't think we should just assume the administration is completely disorganized. What if this mixed messaging is a deliberate negotiating strategy.
Oh, interesting. Like how?
Think about it like a classic good cop, bad cop routine playing out on the global geopolitical stage. You have the hard Sunday deadline leak through back channels to apply maximum pressure on Tehran and force them to the negotiating table.
Okay, right.
Meanwhile, the official White House podium offers flexibility so Tehran doesn't feel publicly humiliated or, cornered into a kinetic, violent response just to save face.
Viewing it through a game theoretic lens makes a lot of strategic sense, actually. You squeeze the adversary with the looming threat of overwhelming force, but you always leave a diplomatic off-ramp.
Exactly.
The inherent danger, however, is that while the diplomats are playing good cop, bad cop in the press briefing room, the military is dealing with the physical reality on the water, and the reality of the blockade right now is incredibly severe.
Severe doesn't even begin to cover it. Despite all this diplomatic talk of ceasefire extensions, the U.S. military actively and aggressively enforced its naval blockade today. U.S. forces intercepted at least 3 Iranian oil tankers in Asian waters.
And in direct response, Iran attacked a third commercial ship right in the Strait of Hormuz. We are talking about physical kinetic interdictions happening on the water right now.
And that reality drove Brent crude up a staggering 3.48% today to settle at $101.91 a barrel.
Over $100 a barrel for global crude, which, brings us directly to the central paradox of today's deep dive. How on earth does the S&P 500 rally over 1% and the Nasdaq surge 1.6% on a day when a physical naval blockade pushes energy costs past $100?
Here is where the mechanics get absolutely fascinating. If you're wondering why your portfolio didn't tank today despite the terrifying headlines, it comes down to the AI counterweight.
Yes, the Silicon Shield.
Right at 8 a.m. Eastern Time today, Google Cloud completely hijacked the market narrative. They unveiled their new custom enterprise chips, the TPU-AT and 8i.
And crucially, they announced massive multi-billion-dollar partnerships with Merck and NVIDIA focused specifically on agentic AI.
The term agentic AI is the fundamental shift here. The market is moving well beyond conversational AI.
Right. We are no longer just talking about chatbots that can write an email or answer a trivia question. Agentic AI refers to artificial intelligence infrastructure designed to take autonomous action.
So systems that can independently solve complex corporate problems or manage supply chains or discover new pharmaceutical compounds without constant human prompting.
Exactly. Google's announcement signaled that the enterprise adoption of this technology is accelerating. And the market's reaction, sending Alphabet stock up 1.7%, is highly indicative of the broader economic mechanism at play here.
Let's talk about that mechanism because it's fundamentally altering how we value the stock market. It is all about cycle-agnostic spending.
Historically, when oil hits $100 and inflation threatens to spike, corporations panic. They immediately pull back on their capital expenditures.
They delay building new factories, freeze hiring, hoard cash to survive the coming recession.
Right. But artificial intelligence represents an existential arms race for the mega-cap tech companies. They are committing hundreds of billions of dollars to build data centers, secure energy infrastructure, and buy custom silicon, regardless of what the broader macroeconomic cycle is doing.
It's like the market has built a fortress out of silicon. The underlying global economy can flood with $100 oil, supply chains can break down, and consumers might feel the pinch at the grocery store.
But inside that fortress, the AI server farms are still being built at any cost.
Yeah.
Yeah.
Microsoft, Google, Meta, Amazon, they literally don't care if oil's $100 or $50 right now. They have to buy the GPUs or they lose the future of the internet.
And that cycle-agnostic infrastructure spend provides an incredible mathematical floor for corporate earnings in the tech sector. The broader market looks at $100 oil and acknowledges the pain for the consumer.
But it also recognizes that a slowdown in consumer spending does not stop the hyperscalers from deploying hundreds of billions into tech infrastructure.
Exactly. That fundamental, undeniable revenue stream for semiconductor and hardware companies is why equities completely ignored the geopolitical chaos today.
It is a phenomenal shield. But, it is important to note that not every sector had the luxury of that silicon armor today. We saw a narrower story pop up that really highlights the vulnerability of traditional industry.
All the tariff threats.
Yeah. U.S. Trade Representative Greer started aggressively threatening Canada and Mexico with Section 301 tariffs as part of the ongoing USMCA trade renegotiations.
Right. And a Section 301 tariff is a mechanism under the Trade Act of 1974 that allows the U.S. to impose trade sanctions on foreign countries that violate trade agreements.
In practical terms, a tariff acts as a mechanical tax on corporate profit margins. For companies that rely on cross-border manufacturing, like bringing parts up from Mexico or raw materials down from Canada, that friction immediately increases their cost of goods sold.
It is a very sector-specific story, but it did cause the industrials ETF, ticker XLI, to dip a minor 0.23% today. It's a stark reminder that traditional manufacturing supply chains are highly sensitive to border friction.
Whereas software and AI models really don't care about customs checkpoints, we also saw some real friction show up in the bond market today.
Right. At 1 p.m. Eastern Time, the Treasury held a 20-year bond auction, and the results were noticeably soft.
It priced at a high yield of 4.883%, and the bid-to-cover ratio dropped significantly.
When the U.S. government needs to fund its deficit, it holds these auctions to sell Treasury bonds. The bid-to-cover ratio is essentially a measure of demand, how many buyers showed up versus how much debt the government was trying to sell.
So a dropping bid-to-cover ratio means demand is waning.
Exactly. And when there are fewer buyers, the government is forced to offer a higher yield to entice them. Investors are demanding higher interest rates to absorb long-duration U.S. debt, primarily because they are pricing in the inflationary risk of that $100 oil.
And higher yields historically increase the rate risk for equities. But again, the tech rally was so overwhelmingly powerful today, the broader market just absorbed that weak auction, shrugged off the rising borrowing costs, and kept climbing into the close.
Completely immune.
All right, let's take one more short break, and then we'll get into the after-hours earnings and tomorrow's data drops.
See you in a minute.
We're back for our final session. Mira, what is the corporate events recap, and what should we watch next?
Well, the momentum from the regular session spilled directly into the after-hours market. Immediately after the closing bell today, around 3:56 p.m. Eastern Time, a massive wave of highly anticipated first-quarter earnings hit the wire.
And they largely validated the aggressive tech growth narrative we've been tracking all day.
Oh, absolutely. Texas Instruments, which is a massive bellwether for the broader semiconductor industry, gained about 8% following their report.
An 8% jump for a company the size of Texas Instruments is monumental. I mean, they aren't just making the high-end AI chips. They make the analog chips that bridge the physical and digital worlds. The chips that go into cars, industrial machinery, and consumer electronics.
Right. Their beat proves that the physical hardware side of this boom is just as strong as the software narratives. We also saw Tesla rise roughly 4% after hours.
Oh, that was on the self-driving news.
Yeah, a key highlight from their earnings call was the continued progress in securing regulatory approval for their full self-driving software in China. The market clearly loved the prospect of unlocking that massive software revenue stream in the Chinese market.
On the flip side, however, IBM fell about 4.75%.
They did.
I was looking at the tape when IBM dropped, and it caught my attention because it shows that this AI tailwind isn't a universal rising tide. Legacy tech players that are slower to pivot or monetize the frontier models are actually being punished.
That's a great point. It's a selective boom. But the broader takeaway is undeniable. The mega cap results absolutely validated the structural tech growth narrative that drove today's entire rally.
I mean, take a step back and think about the sheer absurdity of the landscape we just walked through. We have a literal kinetic naval blockade in the Middle East. Global crude oil is surging past $100 a barrel. We have new tariff threats flying across the Canadian-Mexican borders.
And government bond auctions showing waning demand.
Right. But the Nasdaq still rallied 1.6% today just because Google dropped a new AI chip, and Texas Instruments beat an earnings estimate. It turns out the only global shock this market actually fears is a missed consensus estimate.
Seriously.
So, go ahead and pour yourself a glass of imported wine before the USTR slaps a 301 tariff on it, and just enjoy the tech gains.
It perfectly encapsulates the psychological state of Wall Street right now. Fundamentals in the tech sector are entirely overriding macroeconomic fear. But looking ahead to tomorrow, Thursday, April 23, we have several key data points that will severely test this localized optimism.
What's on the docket?
Right out of the gate at 8:30 a.m. Eastern Time, you'll want to watch the initial jobless claims and the Chicago Fed National Activity Index.
Those always provide a fantastic real-time pulse on the health of the American labor market and broader economic activity.
Then, shortly after the open at 9:45 a.m. Eastern Time, the S&P Global Flash U.S. PMI data drops. This covers manufacturing, services, and the composite index.
Oh, and given the severe stagflation warnings we saw out of the German Bundesbank today, the USPI will be critical.
Very critical. It will show us whether American economic exceptionalism is actually holding up, or if the global manufacturing slowdown is finally reaching our shores. Finally, at 12 p.m. ET, we have a 5-year TIP-yes auction.
Let's connect that TIP-yes auction directly back to our narrative, because TIP-yes stands for Treasury Inflation Protected Securities. That option will give us a direct mathematical read on how the market is pricing medium-term inflation expectations.
Exactly.
If that auction is weak and it shows inflation expectations baking in structurally higher borrowing costs due to the $100 oil, it could eventually crack the foundation of our Silicon Fortress, because even mega-cap tech companies rely on the debt markets to fund those massive data centers.
That's the real danger zone.
We've walked through some incredibly muddy waters today. We've seen exactly how the market is using AI capital expenditure as an impenetrable shield against global geopolitical chaos and $100 oil. But I want to leave you with a final thought to mull over as you watch the tape tomorrow.
Go for it.
If extreme, cycle-agnostic AI infrastructure spending is the only thing immunizing your portfolio against $100 oil, waning bond demand, and global naval blockades, what happens to this V-shaped recovery if the next major hyperscaler earnings report shows even a slight deceleration in capex?
The shield drops, and the market has to face the reality of the macro environment.
Let us know your thoughts and how you're navigating this incredible market in the comments below.